The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. My pleasure to be here Monday through Friday and 11 o'clock till noon. That's this time right now that you're listening to. At 877-927-6648. Thank you, Steve, for 2 great hours following me. We've got a great option hour. Then we've got, let's see, we go today's Daryl Martin, Dave White, Ken Shreve, back here to Tom O'Brien. Wraps it up at 4 o'clock till 6, giving us these perceptive views of what he's looking at versus volume, etc. And don't forget, Thursday night, Bud Rolfs, one of our former hosts here, outstanding technician, is giving a webinar, a 1.5-hour webinar. You go to the front page, check it out. It's essentially the coming 4 years and different techniques that he has discovered and that he uses in his own trading. And that should be not only extremely interesting and educational, but it will give you a heads up to techniques to look for in your long-term overview of the market. So we're looking at a Dow that's trying to come back. Had a nice early morning pop, and then it came back. Let me just do this here. I just want to show the ESM. This is the E-minis. This is a very familiar chart to many of us here. This is that declining wedge from a peak F top at 1558.75 in the E-minis. Remember, I spoke about this yesterday. Has a trend line that must be taken out decisively and held, and the 1545 to 1547 level has to become support. It's trying to do that now. It went a little lower, but it's at 1545 right now. I'm sorry, it shouldn't be 50. It should be 1549 to 1551 is the area that needs to break out, and then turn the 1547 area into support. That's the 9-period exponential moving average. Now, what's really important about this particular move right now is at least the market has held with a positive bias, even though we're looking at some of the sentiment indicators kind of high. The trend is up at 1.04, having gone a little higher today. It's been up over 1 for a couple of days. And what's even more important is that the volatility index, let me just pop that in here, VIX.X. Volatility index has had a very strong move to a leg A. It had a leg A before and then failed at B. I suspect, just for right now, I think that's possibly the way we're looking at this. But I'm going to mention something here which I had only just peripherally touched on yesterday, and that is where we are in the ChapmanWave methodology. And one of the reasons why I still want to keep holding the DDM 200% long the Dow until, I have to say, if we are looking at leg D to come. So this is such an interesting period because this is a great time to be looking at option strategies. So with Victor Jones today in the option hour, it's a great options show. This is a time to call in to develop some strategies. Let's say you've got a portfolio that has done really well, and you want to kind of ameliorate any. You're prepared on the shorter term over the coming 2-3 weeks, maybe 4 weeks, to give up some upside, but you do not want to sacrifice. First of all, you don't want to get out of the stocks that you have because they've done so well. And if there's any rebound at all at any time, perhaps those are the stocks that would rebound. So you want to keep your portfolio. At the same time, you also want to protect that portfolio. So we're going to be doing it in a different way in my opening call. We will probably switch one way or the other. We'll switch into one of the indexes for a downside potential slide after leg D. But I've been showing and talking to subscribers about the ChapmanWave Phantom Peak. It's one of the techniques, one of the myriad techniques that I have. It's over 24 at least. And I would even say that majority of them are proprietary because they apply only to the ChapmanWave methodology. Well, in this particular technique, I suspect that we are going to get the real leg D up in the Dow Diamonds and the S&P SPY. Those are the ETFs that are lagging one peak behind the Dow and the S&P. So meanwhile, we've got some fabulous intraday trading markets here. If you trade the E-minis like I do, I think Steve does, a number of us do. It's really important to know all these different criteria. You know, here at TFNN, we're all about techniques and rules-based methodologies as well as strategies, and most importantly, we all have our specialties. We have our techniques that we use and we're pretty proud of, and we spend a lot of time on them. So, front page is where you can check things out. In my opening call, that's my daily service, where we're looking at some stocks that we've held for, maybe since November. Others we've just got, like the March 4th buy in the Dow on the long side. Sometimes we get taken out, as we did the other day, for a 20-cent loss on a low-price stock. And sometimes we have a crazy day, like yesterday, on a particular stock that we had a fantastic gain on. And then it must have been a report, some kind of news report or something, because it spiked down, took us out. A nice gain, percentage gain, but not nearly as fantastic as it was just the day before. And we've been in this twice before with nice gains. And I'm prepared to try again because it looks like it needs to get to a D. What does that mean? Let me show you here what it means. When I'm looking at the Dow, at 877-927-6648 is the number to call, I'm looking at the potential right here. Let me just do this. I'm going to add that. I'm even going to color it in a little bit darker so you can see it nice and clearly. Now, remember, on the left side, if you're new to my show or to TFNN, and this is the first time you're going to tfnn.mobi or whatever device it is that you're looking at, the charts and the Tiger TV, this is what I'm looking at here. From the lowest low bar in the Dow, the most recent one at 13,784.01, which is established on February the 25th, there was a single peak A on the 28th at 14,149, pulls back. Now it's above the 9-period moving average, this maroon line. The technicals are all very strong, the MACD and stochastic on balance volume. And at the same time, what we're looking at is in the space of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 bars at 16 days, what we're looking at are just 3 candles that are red. And even the candle of yesterday, which is kind of like a Roman candle, but I would prefer if the close was just a tad higher. I like it 50% higher off the wick low, but it still counts. It says that if at any point the Dow goes to the 14,422, 14,400 area, be careful because we're liable to dip underneath 14,400. In the meantime, if there is a close in the next 2 days without going into the middle of that wick, that's very positive because a close above 14,522 will signal a really good chance that this pattern that I call the falling X, 2 trend lines with lower highs and much lower lows, that's the signal that says great, because now there's a potential to make leg D. Within that, there's another context. I wonder if I can go make it a little clearer. I'm going to go, this is what my subscribers get every day, an incredibly detailed report. Look at this, all the work that's done here within the ChapmanWave, saying peak F top, looks like time and price, discuss the Roman candle there as well. We can talk about that now in the 120-minute chart. Most importantly, you've got the volatility index 121 going to peak ABC. Will it fail or will it get to do? Well, we're going to know soon enough. But in the meantime, what you can see is that the cup formation there and basically the resistance or even a potential arch formation. I don't like messy charts, but I'm going to just try to do that now just to show you. I'll make it another color. I'll make it red just only because for demonstrative purposes there. You can see that. Am I getting that nice and clear? I'm looking at this is the black charts. Yep, black charts. And what I like about the black charts is just the most important things just pop right up. You see the rising wedge and the pullback? I could even move that now and say, well, there's still a rising wedge and there's the pullback. And what happens with the pullback very often, you get I always think, I have this imagination, you see. I always think Statue of Liberty holding the torch or with her palms out in a cup formation. I shouldn't say palms out. She's not begging for anything. She's just begging to allow freedom in the United States for people who come here and immigrate. What I'm looking at here is emigrate to the United States. And what I'm looking at is that any new high starts a brand new buy, probably starts a brand new buy mode to another leg in the 120-minute chart. That's number one. But look at the way the arch formation is coming down and the cup formation is going up. And why? Because this is the sentiment indicator, selling pressure as it goes up, buying pressure as it goes down. So this is going to be interesting because if the volatility index at 13.55 starts to decline right here, if it closes the day underneath the low of $12.92, now let's just say if it goes under $13.30 in the next 2 or 3 hours, that's going to be very positive for the market. This is the trend index is showing some high readings, 1.74, 1.82, but not high enough for me to consider that they very, very important. Most important is that same pattern we were looking at, that falling axe, lower highs, lower lows, same thing in the S&P. So this is what I discuss other techniques, but here it is. And now I'm going to make it a little darker. I'll make it blue. And then I give a detailed report on the Dow, what levels we're looking at, why we're looking at it, etc., etc. And then I give a 120-minute chart to show of the diamonds, to show the near-term aspect, as well as the futures, E-mini futures daily and 120-minute chart. A really detailed report. I talk about the levels to watch for, etc. So we know exactly what to look for. A close above 14,515 in the Dow today or tomorrow is going to be really positive, especially if we don't get back to 14,423. We're going to go to our first caller. We've got Mark in Fort Collins, Colorado. Hi, Mark. How are you?
Basil, how are you?
I'm very well, thank you.
Good. I just want to say how much I appreciate your newsletter and how Friday's White Lightning trade was amazing, and I think I made my subscription up for the next 20 years in that thing, so I appreciate that.
Wow, thank you. And, wasn't it interesting? You remember how I said I hate to change my call in the middle of the day because I did my homework. I can just sit there and let it go. Folks, what Mark's talking about is that we had a J.P. Morgan March 50 put option that was bought at 10 cents on early Thursday morning. 9 cents was the low. And I said the levels to get out are 16 cents. It never hit 16 cents on Thursday. For some reason, I thought it did. It didn't. 16 cents. But it did hit the 40 cent range, and 75 cents is where I said, get out of everything. So that was a 400% and a 650% gain on those particular calls. So, hey, those puts, I shouldn't call them calls, even though it was a call on the put. So, Mark, you want to look at what?
I want to look at the IWMs today because we don't talk about that much in your letter. So
I certainly will look at that, and we'll be right back with Mark and Fort Collins, and we'll be looking at IWM, which is the Russell 2000 ETF, and I'll be right back straight after this break.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces. And over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Let's see, Dow's up 33, S&P's up 1.06, and the dollar is up 0.05, holding really well. And bonds are actually up 23.30. This is such an interesting market right now. And to make it even more interesting, we're going to look at the IWM, which is the iShares Russell 2000 Index Trust. And we've got Mark on the line. So, Mark, are you using this just as a gauge, or do you have a position here, or what?
No, I actually just went long with some calls out about a week and a half, expecting we're at least going to make it to the high, if not break through it a little bit more. So I did it literally about 20 minutes ago.
Okay, so this is
the last of the day, actually. So
okay, that's great. Now let me just explain what I'm looking at, folks. We're looking at the IWM. I'm going to move this chart. First, I'm going to look at the daily chart. Let me get rid of this so that you know I'm looking only at this is the daily chart, and there's been a beautiful up channel. And that up channel, let me just say extend, and that extends to the right. But what's interesting about it is that the lower part of the up channel, the trend line that is moving diagonally up, I'm going to take that away to get rid of any mess. I'm also going to get rid of this little area that I've made gray because it was important at the time, but not so much now. What we expect in the ChapmanWave methodology is to go to at least a peak D. From the low bar of 76.13 made November the 14th, I believe it was. This was 713. Yes, this was the November the 16th, the day after the others made their low. There was a gap up, and then what happened is that it held the 9-period moving average, and it went to peak A. And I typed in here, had it as a phantom A, but this is the strict count. So the strict count says that I got rid of that, and I moved the A to the proper A, which was peak on the 3rd of December. That was A. B was on the 12th of December, higher at 83.80. Then it goes to C at 84.77, and then it gaps up and goes to D. And within 3 bars, it isn't actually 3 bars that it makes a new high, 87.44, 87.35. It just misses. It actually turns out to be 4 bars. So I've had to put a down arrow at D and an up arrow at on the low bar of the 8th of January. Now, this is fascinating to me. I love these tiny little moves that basically crawl up the 9-period exponential moving average, and it goes to a D again on the 1st of February. But what I decided was that because it kept going high, even though the technicals were weak, the stochastic did come back later, I made that E to a peak F. And that F was a perfect F, because on the 20th of February, you got a huge red candle, another red candle, under the 9 EMA, and then a whopping big one, and then a doji turnaround candle, the low of the 26th of February at 88.79. And now this is the reason why I want to make a little bit of a deal out of the whole thing. I'm going to stretch the chart a little bit. Well, I wonder if this would be better. I can see it. Let me see if I can see it now. Yeah, I can see it. So what I wanted to show was I have a phantom peak here. Just like I had that A, and then I could get rid of the A because it actually went to a D. I'm calling this, there was a high of 91.05 on the 28th of February, and then 91.06. You can't have too many phantom peaks. That's not very good. I forgot about that. Well, it's 1 penny, and I've got it as a phantom peak because I'm trying to get them all lined up. And as long as I know that there's a phantom peak, it says, keep in mind that legitimately it could still go higher, which kind of suits your case for your looking out about a week. But now this is important. The doji candle of the 15th at 94.96, I've got as, it has to be also, the whole thing is, basically that is really peak A. But I counted the 93.75 highs of the 8th of March, the 11th of March, and the 12th of March as one peak. And one of the reasons is within it, the on-balance volume pullback and the 120-minute chart pulled back a little bit. So I have every reason to say, gee, by 1 penny it failed to do it. So as long as I know that I am changing the rules, but within the construct, and I know what I'm doing. And now let me explain the very big reason why I was prepared to do that. If you look at the MACD, look how powerful the MACD is. If you look at the stochastic at 94%, look how powerful that is. So far, I don't have any signs of weakness other than to say momentarily you could pull back, but the strength of, I would say the strength of 94.30 to 94.60 as a magnet area is really very strong. So I'm going to, if you've got a moment, do you have a moment? I wanted to go on with this?
Yeah, that's fine.
Okay, great. We're going to talk about this IWM and what I'm looking at here on the long side, on the upside, and we'll continue that discussion. And the Dow's up 37, S&P's up 0.86.
TFNN legend Bud Rolfs has come out of retirement to bring you a special report and a one-time only webinar that will show you what's going to happen in the markets over the next 4 years. Bud Rolfs is the former chief technical analyst of the Tiger Trading Post at TFNN and is a true market innovator who has taught thousands of students how to read charts and be more successful traders. Don't miss this chance to learn from a TFNN legend and get this timely market advice that will put you on the right side of the market for the next major move. Plus, he'll show you his expert analysis on the current major markets and explain the technical setup that is predicting a move of over 50%. We're offering this one-of-a-kind special package for only $179, and the moment that you sign up, you'll gain access to Bud's 11-page executive summary where he provides you with the keys to his market call and prepares you for his live 90-minute webinar on March 21st. Don't miss this one-of-a-kind offer. Sign up today on the front page of TFNN.com. Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the market, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Hi everyone, Basil Chapman. Dow's up 34, S&P's up 72, so the Dow's up 20.24%, S&P's up 0.04. I'm not that happy when that happens. I want to see the S&P 500 stocks a little bit stronger than the Dow, but anyway, we'll deal with what we've got. What we're looking at is the IWM. What I want to spend just a moment here to discuss the power of certain indicators. And in the IWM, what I'm looking at, which is the iShares Russell 2000 ETF, the doji candle that was made on the 15th of March at 94.96 saw a decline yesterday right to the 9-period exponential moving average. First time it's even touched that since it broke out on the 4th of March. So this is an important moment. What I'm looking at here is that the 120-minute chart says, yeah, we might take a little time in this oval formation. But if in the 120-minute chart there is a break above 94.71 and that holds for 2 out of 3 bars, so there's still time today to do that, but otherwise it's going to have to overlap into tomorrow, that's going to be very positive and suggest that the high of 94.96 at 3:30 in the afternoon on the 15th is going to be tested and probably taken out. On the downside, this particular candle says if there's just a pop-up and then it comes back in, there could be a a test of the low of 94.02, but the body of this candle between 94.41 and 94.31, that candle itself, the body of the entire candle with the wick, outer wicks, says that that's like a magnet right now. So it gives you a cushion, but it also says I'm a magnet, and to break away from the magnet, you have to decisively get away from my boundary point, the concentric circles. So what's really important now is that there's up and down action in the market, which is part of yesterday's consolidation. We're seeing higher highs and higher lows intraday, but it's not going to be until the IWM, and I suspect in this particular case it's going to be as important as any other index for the IWM to break above 94.71. If and when it does, I think it's more when it does, what will happen is that all of a sudden, the pattern that I'm looking at now, I'm going to make this very dark. I'm going to make these trend lines dark. There you are. Whoops, didn't mean to do that, but that's okay. Okay, let me just get it back into a smaller configuration. Right there, that says that the moment that the IWM starts to break above 94.75, that's the bigger picture, then all of a sudden 94.97 starts leg D. Now, here's the thing. That's leg D with phantom peaks. If I look at the SPY, I've got a phantom peak here. This is actually just peak B. So that when and if it makes a new high above 156.80, that's going to be officially leg C, not leg D. And the diamonds, the Dow diamonds, same thing. Wait a minute. The phantom P, 144.70, 71. That would be B. That would be leg C. So under the strictest rules, I should anticipate that this rally can go into next week if the IWM, the SPY, and the diamonds, that's different to the Dow and the S&P, are going to make that requisite leg D, which I anticipated they will. But more importantly, because you're looking out for about a week's worth of gains, this is leg C in the weekly chart of the IWM, and the monthly chart is really powerful. And when I was showing charts just a moment ago, and I had the IYT, I had an IM from someone in the DAN saying, wow, the transportation index looks powerful. And that's only in leg B. Of course, that's the airline. So this is when you talk takeoff, you're talking a monster takeoff. But look at the weekly chart of the IYT and look at the IWM, and they are vertical. That's what's really positive about a vertical chart, is that if the technicals are still strong, then you get high-level consolidations until it becomes so overbought that it comes back. And then what does it do? It breaks down and goes back under the consolidation area. So my assessment right now is that the IWM still has further to go on the upside. I think having calls is a real nice, easy, inexpensive way to do it. If you're wrong, you know exactly what your stop is. And because you have calls going into April, some premium will still be there. So I like your strategy. It's a little bit of a fight going on. That fight might go into tomorrow afternoon. I think the Fed speak comes out, so it might be going into tomorrow afternoon. But so far, I think that it's acting well, and especially when you consider that the volatility index has had a move from 11.05 to the 1374 level. And the Dow is, I'll use the Dow for the moment, although it really should be the NYA. The Dow is only, right now, 45.39, 60 or 70 or something points like that off its all-time high. That says that the bears got a little too bearish too quickly. They might be right, but as of now, we're trying to work off that over-bearish situation. So, now, just one other thing, Mark. I just wanted to say I'm wrong. If the IWM, I'm wrong about the move coming up in the next few days to the upside. If the IWM takes out yesterday's low of 93.67, I still believe it's going to go to a higher leg. But at this particular point, I just want to give you, if I am wrong, situation. And that would say that it goes in the oval pattern that I've drawn. It goes under a very important low of 93.67. This move right now should not take out 93.67, or it shouldn't close under there. Wow, I hope that helps you. You're there. Good. So you got a little delay. That's the scenario, and I believe you're on the right side of this.
Okay, thank you.
So thank you very much for calling, and congratulations on a great trade.
Thanks. Bye-bye.
Thank you. Folks, the Dow is now up 20, S&P is down 73 cents. I want to do something else here. I promised myself that I would take a moment to do. Let me just go back to yesterday's, what I promised myself I would do, and I didn't. I did want to spend a little time on the GLD. The GLD, which is the SPY, S&P Select Spider Gold Trust, I've been talking about this as having a bounce in the dreaded H formation. I'm going to draw this. Is that clear? I just want to see if it's clear. This is the daily chart. What happens is, in the pattern that I call the dreaded H, it just looks like a lowercase h. Let me make this nice and thick. Color, make it blue. And I'm going to make it weight. I'm going to make it nice and heavy. That's the downtrend line. Sometimes it's vertical, but most of the time it's at an angle. Within that, you get an arch formation that invariably fails at A or B. And it goes A minus or B minus. And in this case, it failed at A minus. But this is the support line right here. I'm looking at the GLD, which has a low of 150.84. And that's key right now, 150.84. My eye, everything about this chart, if I'm correct, my eye says that there should be a break below 150 and should go to 148. And 148 is the area that is going to be the most important. But now look, there's a little mini A to B. And what I said in my CD introducing the ChapmanWave methodology, this is a pattern that I talk about, that the H, the lowercase h, let me just draw this so that you know what I'm talking about. That's the base, and I'm going to make it a little bit light because it's just showing the base area. There you are. That base of 150.84 was tested successfully in the H pattern at 151.40, 84 cents higher, on the 6th of March, which says the next rally can go to or just above the previous high, arch high, that's this high here, of 156.80. But unless it closes decisively above, with the technicals giving a brand new buy signal, there's a really good chance that it's going to fail, even if it makes a slightly larger arch formation and become an M formation. So what happens is that pattern, I'm drawing it in here, becomes, it could be bigger, it could be smaller, but basically it becomes an M pattern. And at some point, if that M pattern is successful, it will not take out the left side low. It'll constantly make higher lows, and that will allow it to break out to the upside. But if it comes back to or within a really close situation like 150.95 instead of 84, you've got to be ready for a dip underneath the support level. That dip says, don't go short, because all that's going to happen is it's going to be so quick that it goes underneath that level, and then it forgot its hat, or it forgot to say goodbye to a friend, so it pops back into the arch, says goodbye, and then it could go even deeper, or it could make another rebound. And I've drawn two rebounds here, but so far there is only one, so I'm going to have to take the other one away. The pattern is still correct, but the number of arches so far is not right. And there it is. So the pattern that says if the MACD and stochastic are strong, it could go higher, is in fact formulating in the daily chart as the MACD expands with the histogram, those vertical lines, expanding as well. And the stochastic has rallied. However, the rally in the stochastic is only at 59%. Hey, That's not good enough. The rally has to get over 80%. If it gets over 80%, GLD is going to test the 157 to 158 area. There's a really good chance it could even go higher. The candle that's forming today is a very nice candle. So what I'm looking at here is that the GLD is forming in the daily the same kind of patterns that it was forming in the monthly. You see that? Look, 148.27 makes an arch, comes back to 148.53, a successful test, goes higher, cannot break above the previous high, comes back with a retest, but a successful retest so far, slightly higher. So this M here that's forming in the monthly chart says, yeah, gold can go a little higher, but I would not be surprised that between 159 and 161, if it even gets there, there's another failure, and that failure is the one that's going to go deep into the 148s or lower. That's my assessment. Could be wrong, but that's just the way I'm looking at it right now. Now, that was the one thing I wanted to look at. Oh, and the other was, I was asked about the longer-term outlook for bonds. So what I'm going to do here is I'm going to, I hope I've got this chart. Here we go, US.P. Yes, I do. This is the very long term. It keeps moving because it gets smoothed out. I have to lower those lines. There. That's the line I'm looking at. That's the line I'm looking at. And that's the line at the bottom. What I'm looking at here is the 30-year. It's actually the 24-year channel bull market. But the bull market in bonds has been going on since 1987, I think it is. So now look at this. When I squeeze this chart, what we're looking at, a beautiful up channel. The low was back in 87. And now what we've got is the channel that's formed from the peak F top in October of 1993, has gone above the trend line. It went above that for the very first time in late 2011. It was October 2011. It went to a peak D/B and E/C. And the question is, can the Fed, with the stochastic and MACD turning down so sharply and the price holding up, what is going on? That was really the question. And here's my answer. I thought I'd say, here's my answer, and then we'd hear the break. Let me just see. Oh, here's my answer. We have got no break yet. If you look at the dollar, the dollar had a spectacular move to 121. Well, I say 121, but it gets smoothed out. Now, it's 121 still. In July of 2001, having gone from the 78 to 83 area back in the mid-90s, all the way to the July 2001 high. Then it made a little V-shaped top failure, and then it came all the way down. And all the way down means it came right back to the 83.03 in an exact left side, right side price time move. It broke under it, went to a trough F, and then rallied up. In all this time, the dollar has not been able, since it broke down in April of 2003, and has not once closed above the 200-period exponential moving average. Now, this is very important. See the rectangle formation? You see the H that turns into an M formation? I will show you in a moment, and we're going to talk about that, because the question that was asked of me is, what the heck is going on, and what do I see? And I will tell you what I see. That's the dollar. And the reason is the dollar was smacked down by the Fed. Now bonds are being propped up.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.
This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Hi, everyone. We're back. Basil Chapman, Tiger Technicians Hour, and there's someone in the den said, did somebody just pull the rug out? The Dow is now down 20, S&P's down 6. And this is really a very interesting period because the amount of time that it's taking to get to that, I call it the requisite leg D in the Dow, is telling me that if there is a move to the upside, that move is probably going to last longer than the 1 or 2 days that you normally would get in leg D and then a pullback, or maybe even a top of some significance. So I'm watching this really closely, and we are now the sparsest we've been on the long side, and we've started adding shorts, and I will continue. I believe that this is a period now where the shorts will benefit correctly. I can't say correctly timed. Of course, everything correctly timed is good. But that's the way I'm looking at it. That's the reason why I want to study how the TLT holds today, how bonds hold today, how the volatility index holds, because it's had a big move and it didn't pull back. Although the market didn't drop like it should, it's held pretty darn well, considering there was a 2 and something point gain in, that was a very sharp gain in the VIX index. Maybe this is part of that whole process. So it's a digestive process. The more we digest here, the better it is to go a little higher. I don't expect all that much to the upside. It's more time than price, but it'll confuse a lot of people. That's what I think. So looking at the long-term bond chart, I believe, just as I was talking about the Dow, the dollar being smacked down, that it should have had much greater rallies, but it couldn't, because its major nemesis, the Fed, at that point, was saying, no, we want you low, and you're going to stay low. We'll do everything we can to keep you low. Now what they've done is they've said, we want you to stay higher, bonds. So it was whack a bond, whack a dollar, and now it is proper bond. They're trying to prop the bonds up. So that's the reason why bonds, theoretically, with the technicals the way they are, bonds right now should be at about 134 to 129. That's my assessment of what should have happened with the MACD monthly and the stochastic monthly so low. So it's being propped up, and you can't fight it. Yes, you can have fabulous trades on the shorter term with the TBT and the TLT, but I suspect that it's just going to be in a fairly historically narrow range. As a trading range, you can make a lot of money with a historically narrow range. So that's the story. So I wanted to go through that. Then I had a quick question, and the question was, in the volatility index, what would be the numbers? Because I always talk about the numbers that are very important, that are going to be something that's key. Let me just go to my 120 chart. My 120-minute chart is extended leg C. I thought this would turn out to be leg D. Going this far and breaking above the gap low of 14.01 of the 4th of March, it doesn't have to even close. Just having gone there says, hey, be careful. On the shorter term, there is definitely weakness. And look at that doji candle in the 120-minute chart of your Dow index. That is now testing halfway into the body of that candle of 11:30 yesterday. So that says be careful, because you certainly can at this point test the 14,404 to the 14,400 level. That'll be key. A close today under that says, whoa, we might be doing a little digesting into Wednesday afternoon, Thursday morning. I still believe we will make the leg D up, but this is part of that process that says every once in a while, before you get to a significant leg up, there's a digestive phase. So, folks, my service is the opening call. Check it out, front page of TFN. Don't forget, Bud's got his just a fabulous workshop coming up on Thursday evening. Go to the front page of TFN, and I will be back tomorrow. Have a great afternoon.